All right. Let's talk about money today.
Sure.
We're going to talk about money, raising money. We've got groups with us now. Let me do some introductions. Virtually, we got Brett Cenkus. A little intro for Brett. Brett was one of the first people I hired working at Boulder because I had to raise money for Boulder, and he did the entire legal side of the capital raise. He is a wizard, just amazing when it comes to the knowledge of this stuff. So I'm looking forward to having you. Welcome, Brett.
Thank you. Glad to be here.
That's right. We've got Jake and Lance. They are kind of starting a venture.
Sure.
And need to learn about raising money. So I thought, well, hey, let's get the expert on the line with Brett and dive into it. All right. Let's talk about raising money. So Brett, I'm going to go to you first, maybe get us started, and then I'll let Lance and Jake obviously ask a lot more deep questions. But give us like the 10,000 foot level of raising money, what people have to know at the absolute minimum.
Okay. So in the United States, whenever you issue a security, when you sell a security, and a security is a share of stock, a partnership interest, an LLC interest, a convertible note that's going to convert into equity. It's really kind of anything the SEC wants it to be, but fundamentally, someone gives something of value, usually money. They intend to get something of value back, usually money, a return, and it's based on the efforts of the people they're giving it to. Now you have what we call a security. Again, shares of stock, LLC interests, convertible notes, SAFE agreements, all that stuff. That's regulated in the United States, and you've got to comply with securities laws. There's state securities laws and there's federal. And so there's kind of a myriad of like laws to comply with, but you've got to start with, you need to comply with laws. And so you either have to register the security with the SEC and state regulators, and think of IPOs and very expensive processes, or you need an exemption. So whatever we do, like with Boulder or a private offering raise or anything where we're raising a couple of $1 billion or friends and family or Series C and A and B rounds and all this stuff, these are private offerings and we have exemptions. But you need to find specific exemptions. And if you've got certain federal ones we could talk about, they sometimes control entirely. You don't have to worry about exemptions at the state level. Other times you do. So you kind of need to figure out, okay, and in every conversation when we start, maybe if we're going to dig in here, we'll start the same way. When we do an intake with a client, it's, okay, what are we doing here? Like that really starts with, who are we getting the money from? You know, kind of how much money do we need? Who do we think we're getting it from? And then how are we going to get it? So it's really a very, like, let's get really pragmatic about how we're raising the money, because that is going to determine what exemptions either are available for what we want to do. We got to start with finding exemptions that work for us. So, and when I say that, like the two very big things that come up with who are we getting money from, we have accredited investors and non-accredited. Accredited is a defined statutory term. It's a hack for someone who can kind of take care of themselves. But it means they make $200,000 a year or $300,000 if you include a spouse, or the $1 million net worth, not including their primary residence. So we have to have this conversation. Are we raising from accrediteds or not accrediteds? Because the world gets very different if we need to use not accrediteds. And then how are we doing it? And that is fundamentally, do you want to go advertise, cast a wide net, people you don't know, or do we have a network we're going to approach one-on-one? Those are two big questions that define, okay, now we can start figuring out where we go, what exemptions are available, and what those exemptions require of us from a disclosure and filing standpoint.
All right. So I'll summarize that. What I'm hearing is, obviously when you decide you got to raise money, in our case that we're talking about today, it's all going to be about private. Obviously, we're not talking about going public with kind of new ventures. So we're talking about private fundraising. And what you're saying is there's exemptions that have to be met. And then there's basically two very major decisions of, am I going for accredited investors, which have a certain level of experience and knowledge or qualifications, or non-accredited, which could pretty much be everyone, but there's going to be a little bit more restriction. All right. So I'll start with the first question then, Brett. So is there a dollar amount that matters as far as what I have to do based on the raise? Like, let's say I'm just trying to get a really small business started, raise 10 grand versus obviously what Boulder did. We raised almost 8 million. I would assume there's different levels of like, all right, now we're in a much more serious situation, or does dollar amount not matter?
It's a great question. So there are certain exemptions where the dollar amount, there is a limit. That's not common though. And maybe we should talk about, it might be helpful to talk about the two very big exemptions, if I can for a second.
Yeah, of course.
One is Regulation D, Rule 506B. That gets the lion's share of private offering activity. It was put in place in 1982. it's very flexible. So basically you can raise as much money as you want from as many investors as you want with no specific requirements. It's very, very flexible, provided all your investors are accredited. Then there's no limit on money. It's great. And so the exemptions where there's an actual statutory defined limit on money are more nichey, right? And I don't know that makes a lot of sense to peel those back right now. There's 506B. Then there's just 4A2. And these are just references to Securities Act, these numbers. But 4A2 is just a general catch-all private offering, right? It's been around since the Securities Act written up in 1933. And it just says like any offering that isn't essentially a public offering. But that's also quite flexible. There's no dollar amount. There's no number of investors. There's no required disclosure per the statute. However, it's the case law behind what it means to be, to fall within that purview of that. So you've got this just general private offering statute, and there's no specifics, like there's no $1 million is the cutoff, although there's a lot of factors that go into this. So the number of investors and the relationship among them and their average check size and all these things. At some point, the amount of money or some other factors start to break it as a private offering. It just doesn't feel like an exemption we can rely on. And so these are the two big ones we're using, and neither of them has a set limit. But if Reg D 506B, we're comfortable raising $50 million. I mean, it's no problem because it's very clearly sort of defined in the statute that there's not a limit. This other one, very flexible, but again, the number of investors, the amount of money, a lot of things start to like compile and become an issue at some point to using that one. And then you've got, again, the niche ones where there are limits. But generally speaking, this is the world we're playing in, and there aren't specific cutoff amounts.
So 506B is the more common?
It is, yeah, because it also has, I think, maybe 70-80% of private offering activity is done under 506B. And in the past 10 years, there's been some great new exemptions rolled out. But I heard about regulation crowdfunding and some other regulations that have a lot of flexibility that the securities laws didn't have before. But 506B still has the lion's share of the offering activity. Because if you don't use non-accredited investors, it's really, really flexible. And it trumps, it's a federal exemption that basically controls, so you don't need to substantively comply at the state level. You need to file notice filings with states so they can kind of know that you did something in their state, you pay a fee, but you don't have to find exemptions at the state level. So that's really flexible, really helpful for avoiding that whole maze of what they call blue sky laws, which are like the state laws. So it's great. And it's a presumption that it's a private offer. I mean, it's really, really great. It just, again, as long as you use all the accredited investors. The minute you invite a non-accredited in, now you have a statutory list of things you've got to provide, and the disclosure starts to be burdensome to the point where we can usually talk people out of. Kind of feel like you and I might have talked about this at one point. We're pretty successful talking founders out of including non-accrediteds and no raise. It's like, it just doesn't make a lot of sense to take the $5,000 check and spend $10,000 on my work to disclose what we need to people. I mean, to check all the boxes exactly.
Yeah. So to summarize that, because Brett, we did talk about it, because when you're raising money, it's very hard. I think everyone knows that. And you're going to find someone that's interested that might not be an accredited investor. And you're going to go, well, I want to accept that check. But what you're doing is you're opening up an entirely new can of worms of who can participate. And to Brett's point, it has a whole bunch of different disclaimers. And just for layman's terms, an accredited investor, break that down for us, Brett. An accredited investor is what, by definition, at layman's terms?
Yeah. They make a certain amount of money every year, or they have a certain net worth. There's a few other things, like they got certain FINRA type licenses, like Series 7, the financial advisor kind of licenses. But really the classic one is they make at least $200,000 a year. That looks back for 2 years. And in the current year, they've got a reasonable expectation of that. Or if they include their spouse, $300,000. If you include spouse's income, but then you got a higher number. Or $1 million net worth, not including the value of their primary residence. So there's one of two ways, net worth or income, that they qualify. And again, it's just the SEC's hack for someone who's sophisticated enough to take care of themselves. And it's a self-certification under 506B. So they just say they are. We can't have a strong belief that that's wrong, or something. Like we're going to have an obligation at some point. But generally speaking, it's fine. Just rely on their self-certification. And so again, it brings you back to 506B is really, really, really flexible. A lot of protection. Trumps the need to worry about state substantive filings and things like that. So that's, again, what we're using with anything that's outside of that purview and that 482. That's the friends and family piece. That's like clearly a private offering, amounts of money, relationship, all this stuff. Once we start to stretch the bounds of that, we just go for 506B.
Got it. And a key point, it's income or assets, not both.
Correct.
They just have to meet one or the other.
Correct.
And not including your residence, right?
Correct.
Okay,
that's the big one.
Now, Brett, when anyone is raising money, they themselves don't have to have any special license to get this money together, correct? It's just all about disclosures or how you're defining what the offering is. There's no Series 7. There's no degree that we would have to have.
Nope, nothing at all. You can't use finders. You can't pay people to help you raise money unless they have licenses, the registered broker dealers. But you, as a founder, there's no class you got to go through, a certification or license or anything you have to have at all. There are some exemptions that if you've got a prior, assume you don't, since this is sort of the 101, but if you had a prior SEC violation, like there's certain bad actors that make exemptions not usable, right? So founders have, they do call bad actor disqualifications, basically. So if they had a prior SEC issue, like were suspended or something like that, that would be an issue. But that's the world of requirements. If you're using finders and brokers and dealers and stuff like that, or you've had past issues, otherwise now you're totally clear to raise. Minors, felons, orphan, anyone, it's fine. Yeah.
What about using social media? Is it something you can promote something via social media or?
Yeah, great question. So historically, the answer is absolutely no, any private offering. However, in the past, it's almost 10 years now, the SEC rolled out 2 exemptions. Well, there's always been an intrastate exemption that's allowed you to advertise a little bit, but probably not social media level. So let's put that aside. There's 2 that came out in the past 10 years that sort of fundamentally changed the world of advertising private offerings. And that's regulation crowdfunding. So regulation CF and 506C. We've been talking about 506B. There's a new 506C. And so both of those allow some degree of promotion through social media. Regulation crowdfunding, the limit's up to $5 million, but it's for raising to advertising. You could sort of advertise your raise. We'll get into that. It's a little bit restricted, and then raise from non-accrediteds. So it's intended to be small checks from the crowd. And all those deals have to run through what we call crowdfunding portals. There are sites that are registered with, or companies registered with FINRA that control all of it. The disclosures and the raise and the questions and answers and all that has to take place through that portal. There's just limits to what you could say, but you can go onto social media and say, hey, we're raising money through crowdfunding. Go check it out. So there's a certain amount of promotion that's allowed in specifically that exemption. And there's all sorts of requirements. There's a filing with the SEC. It's called Form C. It's not a terribly burdensome filing, but it's a filing that gets reviewed. There are some requirements for financials. So there's a lot of things that come with it. But again, that one allows you to advertise. And then 506C, unlimited amount of money from an unlimited amount of investors and no specific, it's just like 506B, except you could advertise any way you want. You can take out radio ads, billboards, anything you want. All of this, by the way, you got to be careful what you're saying generally, but like there's not the restrictions of just go to a portal. You could say, we're raising money and this is great. And you're starting to see these on like ESPN radio and stuff. They're pitching like real estate investments and things like that under this 506C. The thing that makes it different than 506B is you need to confirm these investors are accredited. So basically there's a certification process, not a self-certification process. See their tax returns or get letters from their accountant or something like that. But that allows a lot of flexibility to pitch that deal.
You couldn't just let them check a box on that. You got to verify it.
That's kind of the trade-off. And so fundamentally, you think about it, the SEC has always been worried. It all goes back to a guy named Howie who was selling orange citrus grove investment schemes to widows and knocking on doors in 19.
Howie messed it all up.
Someone was going to do it, but Howie got it done. Yeah. And so the SEC is worried about people that can't take care of themselves, right? Just getting excited and throw their money away, right? So it's always been, this got to have a relationship. You can't advertise. Or if you do under crowdfunding, it's a small amount of money. They have limits to how much you can take from a non-accredited, how much they can put it across all sorts of different investments in a year. And then 506C, you got to make sure you got to prove they're accredited. But very flexible. We never before that could really advertise these deals in any manner at all. Even blast out on emails and stuff like that. There's at least some flexibility that was never there before.
Yeah, and that does matter because trust me, when you're raising, you're going to get to the point where you've knocked on all the doors, and you're like, I just need more people. I must have had this conversation with Brett 4 or 5 times of like, can I advertise? Like, well, you'd have to change regulations. And it's a bigger deal. And so we ended up not ever doing that. But I think what's important, the context of this, there's so many regulations, exemptions, all the legal stuff. The bottom line is the SEC put this in place to protect the investors. And that's what's important to understand is why you can't just go advertising and getting whoever to invest, because if someone doesn't have the knowledge, the expertise, and they get investing in something that is highly risky, but they really don't understand the risk, they could lose half their net worth as an example if they're not accredited. And so that's why these exemptions exist. The SEC has said, hey, look, there's certain knowledge levels or income levels or asset levels, whatever it ends up being, that we feel that person can look out for themselves versus grandma that may only have 10 grand in the bank and somebody comes and asks her to invest 5 grand in a highly risky thing. So this is really to impress and protect the investors.
Yeah, that's right.
Okay. Well, Brett, so after that, when it comes to real estate, are either one of these more specific or more commonly used for people who are engaging in real estate? Whether it might not be just necessarily a note, and we're not even sure exactly what, but the different options where if you were going to raise money to then go buy something where there's an asset underlying that investment versus give us $100 and later we're going to give you 120. Does that make a difference at all?
Well, you borrow money from a bank to mortgage a property. We're not complying with securities laws. The bank, there's a point like they want their money back, but it's not an investment contract, right? You're not looking for profit. You're looking for a return. So aside from convertible notes that we use in startup context that convert to equity, a straight up just note oftentimes it's murky, but oftentimes will fall outside the purview of securities laws to begin with. So depending on what you're doing in real estate, how you're structuring that deal. Now, I don't think you're telling me or asking me if I just go borrow money straight up as a loan on a property I bought, but there is a world where that's what you do with an investor and we get comfortable that it's not a security to begin with. If you're raising money for a little fund or a little SPV and I'll go find a deal and we'll split the profits of that in some way. So that's not a note, right? It's not a loan. It's equity into a vehicle, that it's a security and it's not fundamentally different. Other than, I've been doing this for 25 years, going on 30. The whole conversation about, especially when we're using that 4A2, that little private offering, non-accrediteds, and it's just like, what's going on fundamentally in the risk of the deal is something that I'm taking into account when I'm trying to guide a client on how much disclosure we have to do. Because not surprisingly, clients want to spend as little as possible on legal, right? And so when we're having this conversation up front, it's tough because as Paul said, you're running out of, it's not working out exactly like you thought it would. And now you're trying to expand and do different things, but we have to have a very clear conversation, very candid about where we think this will land and how we'll get our money. We're also guiding the client on, we use 3 buckets, 1, 2, 3 of like the level of disclosure. And so that's going to play into that. It's a very qualitative, subjective decision about like, hey, fundamentally, how risky is this? And if it's very secured and all you buy is one piece of property, and it's going to play into that a little bit. Like we would never be, let's just say you got to buy one property and you're going to keep 80% and you got to get investors. You're never going to fund 80% of the purchase and they're going to get 20% of the profit and you're going to have the other side of that. Let's just say we're never going to have this full boat private placement memorandum, all the bells and whistles that come with like a lot of disclosure that we might have under 506B. But fundamentally, you still got to find exemptions. You still got to make sure you're within there and it's still a security. So it's probably not much different practically, from your perspective.
That's interesting because the way you just said that, it kind of clicked with me of, okay, the SEC protects the investor. We just talked about that. You're protecting the company raising the funds in the event something goes wrong and the investor sues or comes after the company that raised the money. Brett, what you're doing, putting in place for the company that's raising the money is the level of, hey, we followed the steps, we followed the disclosures. And that's why you're saying if there's a lot more risk, you're going to be a lot more comprehensive with kind of how you're structuring the legal side versus if it's just buy an asset, own the assets, have collateral behind it. You might not have to go as deep on the legal side. Because you're right, legal costs are critical because we spent a significant money because we were raising a significant amount of money and there was a significant amount of risk. Whereas if I'm only raising $50,000 to buy a single family home and something like that, Brett, you're saying it might not be as extensive, which could help minimize the legal costs.
Yeah, absolutely. And I don't know that most lawyers look at it like this, but I bought a lot of legal fees. I've been out of the legal seat for 10, 12 years of that 30-year career, really. I mean, I realize it's stuff you can't divorce it from like your budget, right? It don't make any sense to spend $30,000 on legal to raise $50,000. That just doesn't make sense. And fundamentally, if we're not doing something criminal or unethical, it's all a question of risk. And, business, you accept a certain amount of risk. So we're trying to help guide the client. And you can think about the work we're doing here as insurance. And you can overinsure, right? That's a thing. And that's not a smart thing to do generally. Of course, if something goes wrong, you'll wish you had, but we don't know where it's going to go. So we got to make good decisions with limited dollars. And so it wouldn't make sense. Yeah, those buckets we're doing are based on where's this thing going to go and what's the risk to my client and what's the right insurance for them to buy. Yeah, I've got no interest in selling more to them because I got always a lot of other stuff to work on. But I think fundamentally, a lot of lawyers come at it, frankly, and just think you're trying to de-risk as much as possible. And I think about, no, you're trying to de-risk the right amount, right?
As much as needed. Yeah.
Yeah. And that's a hard clients who are sharp and interested, asking their questions like you get it. And it's really easy to have that conversation. Sometimes it's a little bit harder, especially when they come at it thinking, I don't want to spend much money. How do I just guide this to that lower end? So it's like there's a little bit of having to break on through and be candid together, convince someone that I'm not trying to bring you up into the next bucket unless I feel like we just have to. And as you said, it can be hard to pivot mid-raise. And so sometimes we got to sort of default up that ladder a little bit or accept that we missed and accepted a little more risk than was ideal. But that's the kind of conversation we're having. Yeah, it's to protect them, a little bit to protect me. Fundamentally, the client is the company raising usually, and we're just trying to keep them and the founders out of hot water. And if we do that right, I'm trying to think I don't know. I'd have to really think about this because people threaten stuff, but I don't think I've ever had any litigation about a deal that we've done. I'd have to think about this again. We've done lots and lots and lots of deals, but yeah, a lot of that has to do with because we're dragging out and putting the right information and so forth and doing this right. All that technical back filing, exemptions, all that stuff needs to be done, but it's not the important thing. The important thing is like, how do we make sure that for what's going on, we did the right amount of putting stuff out there for an investor to protect ourselves.
As an investor in Boulder, I remember the paperwork does a very good job of telling the investor basically not to invest. That's what every pay is like, you're going to lose. Everybody pretty much loses. You might win every pay. You know what you're getting. Extremely protected.
Yeah, it is. It's sometimes clients, especially the first time they're doing this, they're like, whoa, do we have to say it this way? And the good thing is a lot of investors don't read this, right? And so we don't have to worry about them. But the ones who do tend to, at least when we see the feedback, appreciate that.
That's a good point.
Yeah. But there are times when a client will come and say like, do we have to say it that way? And, we're willing to have that conversation. You can't sort of totally dilute a risk factor by saying, hey, we've never done this before, but we've worked on this. You can't gut it, but you can nuance it, if there's sensitivity, stuff like that. But yeah, there's funny that you have that memory of that, but I don't remember any conversations about like, do we have to say it this way? It's like, look, if I have a problem with the reality, whatever, there's other checks,
Can you at least preemptively saying the SEC requires us to say this? Is we're not saying this by our own choice. So we believe in the deal. We don't think this is not, I guess you couldn't say you don't believe it's as risky as the SEC is requiring you to say, can you?
No, you certainly can't say that. Yeah. And even the first version of what you said is probably not something we could effectively communicate with all the nuance and time in the world to say it. It's really because it's sort of gutting things. Now, I'm not suggesting that we encourage our clients or know our clients run around and say none of that stuff matters. It's not really true. But like there's that in-person communication that helps soften that a little bit. And obviously the passion you're bringing to the table. And look, every deal has risk, fundamentally. And we do have a pretty good lead into risk factors that sort of maybe some days I think it's too cute by half, but I don't really overall think of like, look, we're not talking about everything that could go wrong with every business. If the economy goes bad or we don't have the right people, like there's no risk factors to every business in the world. And we're not going to talk about, we're going to talk specifically about stuff that's unique here. It gets us out of having to talk about all the other stuff, but it's also like putting us focus on, every investment is risky. So that's probably about as close as we get to what you're describing. But in the end, it needs to be pretty darn clear if it ends up in front of a judge,
Yeah, that's the way to say it. And Brett, you may not know this, but Lance and Jake, this is their second podcast with us. The first one we did was more about like, I call it the art of the conversation. Like, how do you even get in front of investors? How do you talk with them? Today is all about the legal, the science. So what Lance was just asking about is like, okay, in my experience raising money, let the investor guide the questions about the risk. And then obviously you have to be very upfront, very clear with it. But as Brett mentioned, I found people actually appreciated it more because they saw the due diligence we did. They saw the legal forms that were in place. It didn't just feel like, oh, here, give me money and sign this 1-page document, right? Like it actually, you were bringing a level of professionalism to the deal that an accredited investor, who is primarily who you're going to be going for, if not exclusively, will appreciate. And so in my experience, everyone's nervous of like, oh my gosh, we read it line for line, like nobody's going to invest in this. But it's like, well, to Brett's point, everything's risky. We have to make sure you understand it. I'm here to answer questions that you have specific concerns about. And if they do have concerns, say, yeah, I mean, the reality is if this went this way and that went that way, I mean, there is that risk of losing the entire capital, whatever it is. So it's being upfront, but having the legal docs, I think, provided a level of professionalism that helped more than hurt.
Again, as an investor, I think it's a very unique perspective I have where I was sold before the paperwork.
There you go.
You know, I went through 2 different presentations. Paul was all in. And although I read it and I was concerned, I was sold. You know, I was like, I knew that, of course, there's risk. And I felt like this was probably more on my side. I wasn't being told it. I felt, you know, I get this as a worst case scenario type legal document. Still scary to sign on some ways, but I'm in. I think that's what you want. You want to get your people to that point, but from a positive standpoint, not from a negative standpoint.
Yeah, exactly. You want them to believe in you, believe in the deal, and they do have to have it.
And if I didn't know you, we're different. You know, I'd have read this document differently. I might not have invested, but so that's where you really want to start. Is you got to win those people to a degree that
well said.
The document doesn't matter really, although it does,
of course.
Yeah. You can just look at it from a sales perspective, like take it up a legal hat, which I think I do pretty well. Like I strongly feel like over the years that times I've seen that somehow these risk factors, how clear and scary they are, it causes someone not to invest. Like, as much as I get a perspective into this whole process, I feel like we gain more than we lose with it. And I'm not just talking about the protection on the backside. I'm talking about the investors that invest, like my brother, for example. If he's not seeing that, he's like, what is going on here? Who is this? Have they ever done this before? What do I got here? We tell clients, I mean, every couple of weeks I'm talking to a client saying, who's making an investment, like, what is this here? They're raising $10 million. This is what I'm looking at. I'm worried. Like, no one wants to blow money on legal, but do they know, are they playing in the right ballpark? Like, because this isn't what I'd expect to see. Who is their counsel? Do we feel confident they know what they're supposed to be doing? Is this the right outlier? It's like, that's a thing. And, I'm sure there's been some people who've walked away over the strength of our disclosure, but it feels like on balance, it gets more, again, just for a sales job is my strong feeling, let alone on the back end. Obviously, you're going to really wish you had it, right? And even before it gets to court, you're saying to an investor, really? Like, I don't know how I could have said it more clearly. I really don't.
Well, what Paul said too, I mean, makes all the sense in the world. And I did not even think about that. And the reason why I was asking those questions is because I feel like when you're giving them 20 pages full of all the risk and all these disclaimers, it's scaring them off.
More than 20, but keep going.
Any amount. I just thought, what can we do to counteract that? And that just shows how little experience I have. What Paul just said, yeah, these are the risk, but here's what we're doing to combat that. That's the way to approach that.
Yeah, and this is a document. I love what Brett said, which is the people that are going to be investing in you have done this before, most likely, and they know what to expect. And if you don't give them a level of legal documents raising money, they're going to be like, does this person know what they're doing? This is not the level of legal protection I would expect for a business. If they're not doing this up front, what mistakes might they make later? So I do think it adds that credibility. And then what I would say, Lance, don't over worry about that document guiding your conversation. You guide the conversation. You provide the document. They can read it. Let them ask you questions about it. But your pitch, if you will, should be your pitch deck. It should be your pitch. You don't go to the document and start pitching off the document. Provide the document. They have the ability to read the document. They'll ask questions. But you control the pitch. Say, here's what we're doing. Here's how we're approaching things. You should address risks, obviously, through that. But I mean, again, we raised $8 million total and have over 50 investors. I don't remember ever going line by line, PPM, and having any issues.
I don't think I even asked any questions. I mean, it was honestly a good reality check for me. I was kind of in.
That's what it is.
High, I was like this, what I mean? It was good. Okay. It brought me to earth a little bit here. And I think that's what it's trying to do.
That's great.
Because, a good salesperson is going to get you on high where you assign anything. We're trying to protect, hey, Yeah. This is the second bout we did, and we signed it, but we didn't even bring it up, I don't think.
Yeah.
No, maybe we might ask a question.
Yeah, which is normal.
I don't remember being that big a deal.
Correct. I love this because you have the investor perspective.
Sure.
And now that you're going to be raising money, you're now on.
Well, that's why, I mean, when we decided maybe we'd talk about maybe doing our own fund, I mean, I know the guy called.
Yeah.
And then you put us on the Brett too. So we're very novice, although we've been working kind of for a fund and bird dogging for them for a long time. We've never really considered doing our own, and barriers to entry are far less than we thought. So it's an interesting topic to discuss for us.
The key is having the right counsel, which is why I wanted to bring Brett.
So because the first step.
It really is.
First step.
You want to do it early because if you do it late, it's not going to help you.
So there was a question earlier about, do the founders, basically the group raising money, need any special licenses or anything? And I talked about like finders and then the bad actor stuff. But there are also, I just heard the word fund. If you're creating a fund, right, like a real estate investment fund or a private equity fund or a venture capital fund, there's a whole world of financial advisor regulation that you got to sort of navigate. And that typically is going to be an exemption from the Series 7 world. But when I heard fund, I just realized I probably didn't say everything I need to about that earlier. Put together a fund where you're raising the capital, you're going to go put it to work. Again, VC fund, real estate investment fund, stuff like that. That does have a level of certification.
So what I'm hearing, and I know the question I would be thinking is, okay, what makes a fund versus makes just an investment? And is the difference how the money gets used in an investment? We know exactly how it's getting used versus a fund. It's, hey, give us money and we'll just go start picking things that you may or may not know about. Is that the difference? Or what would be the difference between a fund?
Yeah, it's a good question. So fundamentally, the accent mark shouldn't be on the word fund, probably. It's sort of on whether or not the person raising the money is going to then take the money and put it into an investment, sort of like rather than an operating company, right? There's this distinction.
Right.
So that's, I guess, the sort of the first part where we feel like when you raise money for Boulder, you're running a business, right? You're not looking for an opportunity to invest in, and so that's kind of what puts us into financial advisor territory. So, but then the distinction between a one-off, like an SPV, a special purpose vehicle where you raise money to buy one property versus a fund is whether or not the opportunity is identified is kind of a distinctive point. But regardless, whether or not there's one investment versus, and usually the investors know about it up front or before it's sort of ultimately funded versus you raise their money with some general thesis and then you go find investments, right? So
that would be the fund.
That's the thing that kicks us from, are we investing their money into other opportunities or are we running a business? When we're investing, we're still thinking about this issue. What kicks us into full blow, hey, we need a private advisor exemption or somehow we got to deal with this license stuff is that collecting money and then putting it to work and not even telling them how you're going to make that invest. It's like, we're going to invest in real estate opportunities we like, and then we just go do it. So it's like the check is given with blindly, like without information about exactly what's going to be purchased. That kicks us into full boat fund advisor, private advisor exemption territory. So
do you think you typically need some successful SPVs to kind of bridge to the fund?
Usually. Yeah. Everybody's goal was doing the SPVs is to graduate to just having the pool of money you can put to work.
Going right to a general fund is probably pretty difficult with that. Well, we do have a track record, but not necessarily. Anyway, it's interesting.
Yeah. Absolutely. That's the progression. Yep.
I'm super interested in this. So I think I'm trying to learn now, just out of interest, SPV versus general fund. I mean, Jake, you're picking up what he's putting down, but I'm a little slow behind the wheel on this one. Can you give us a breakdown, Brett, of what Jake was asking about? Y'all were in sync, but I'm kind of trying to catch up.
Yeah, so you see this sort of more in real estate, but we also see it in private equity and VC where someone identifies an opportunity, right? And so they're thinking, hey, that's a great business to invest in or a great property to buy, but I don't have all the money. I got to go raise it. And so they're raising it to invest in someone else's deal, kind of.
Yeah.
Generally. I mean, it's real estate. You're buying a property, but like, think about it. What is best to think of that use case? Or let's think about just private equity. It's a better example for what we're talking about here. So someone identifies an opportunity. So they're like, oh, that'd be a great company to buy and grow and turn around. I don't have all the money I need. General private equity, Blackstone and, all those have huge multi-billion-dollar, funds, $500 billion funds that they're going to put they're going to buy, invest in 20, 30, 40 companies, right?
Yep.
Here, an SPV is someone saying, I want to be in that business, but I can't raise a fund, or I just found one great opportunity and I want to be the person leading this deal, acquiring a piece of this company, guiding it the same way the private equity group over at Goldman would do. They set up an entity. They show that deal to investors and they say, look, I want you to come in and you're going to have 30-40% of this deal for this amount of money. I'm going to manage it all. Again, but you're not raising money to operate your own company. You're raising money to put into someone else's company and manage that investment, right? And so that happens in real estate, private equity, venture capital. And then the people doing those SPVs are all generally wanting to progress to the point where they can raise a bunch of money without having deals identified up front, right? That's the fund. And then just put it to work with a management fee and a carried interest and things like that. So that's the distinction. Is the one-off deal where we show it all to investors. And again, the investors in that world are underwriting the deal as much as the managers or the promoters of the deal, right? They're underwriting the jockey and the horse. Whereas in a fund, they're just underwriting the manager, the promoter, the jockey, if you will, right? Because they don't know what the deals are going to look like. But it's more flexibility. You can move quicker with your money. You've got more control rather than every single deal having to come back and sell again to investors. That's the distinction.
And when we say SPV, are we referring to special purpose vehicle? Is that what this thing is?
We are, yeah. Sorry, I should have defined that right out of the gate. But yeah, usually it's an LLC, but it's just an entity that exists for the purpose of, one deal, right? One
deal. Okay. Now, what if, I think a very common use case that a lot of people would try to do and then ultimately try to raise money would be like flipping houses. Let's use a very basic example, Brett, here of how you would counsel someone that says, I'm going to flip houses. I need to go raise some money to be able to, I don't just want to flip one house. I want to flip multiple. I need to raise some money to help me get some down payments. And we're going to do multiple houses and use that money to keep flipping more houses. Like if that was somebody's thesis, vision, which I think is a pretty common thing people would want to do, how would you counsel them on what they need to do to raise money if flipping houses was what they were kind of interested in doing?
Yeah. So the first conversation we're going to have is that intake conversation about, do we know where you get this money? We got to figure that out. They come to us and say, I had no idea. And we got to start talking about, really? No.
Let's assume it's friends and family, which is pretty common too.
But then, let's say they have some idea, right? So then we're thinking, well, are we going to structure this as equity? Or is there a world in which we could do it as a loan with a return and get a world where we're saying, hey, it's not a security? Again, loans can be a little murky, but let's just say we can get comfortable that we don't have to be in securities territory.
Okay.
That's great. It's just easier, and that would be a fixed return no matter what, secured by the property kind of thing, right?
Gotcha.
With what you're describing, that probably doesn't work. These friends and family probably want a piece of the action, but that's the first decision we're making. Can we get out of securities law territory to begin with?
Okay. That's great.
If we're giving them a cut of the action, some upsides and profit and stuff, we're clearly a security, right? Then we're just probably talking about, it's still probably simplest with them to guide them towards away from the fund, right? The fund's going to be a level of like regulation and disclosure and stuff you probably want to get away from if you can live in the world of, let's just find a property, go get some money. We have some documents that cover it over from a securities perspective. Friends and family is going to be usually just generally a lower level of disclosure. The fact that this is all backed by real estate also, probably make it pretty easy. And can we get used to using these docs kind of over and over with a little bit of a tweak and stay in this sort of what we'll call SPV world of one-offs, rather than graduate to that fund, which is going to be a lot more legal work, frankly. So.
Well, good. I will start to wrap this up. Brett, that was incredible. One thing I didn't mention at the beginning, Brett went to Harvard Law. I mean, we want to talk about...
That's president and lead with it.
That's right. He's a very humble man, but the expertise is there through and through. What's interesting is this is fully a full circle. I found Brett by listening to a podcast about people raising money. And I said, I got to call this guy. He's out of Austin. Obviously, we're out of Dallas. So I drove down, sat with him, and immediately was impressed. Because this is a very important thing for your business if you're raising money. It's also very technical, and you have to have that legal counsel to protect the business, to protect your investors, candidly, all the way through. And so you want to find the right person. And so, Brett, thank you for joining us. Lance, Jake, thanks for coming in again as well. We wish you the best of everything. Yeah. Thank you.
Can I say one word, Paul, about I got the call. We get these calls from people wanting to do stuff, but he's going to drive down from the Dallas area, and that's great. And pay for an hour up front, and obviously presents very well. It seems buttoned up. But I'm still thinking, this is a huge project. This is a lot of money. Like, let's see, but it didn't take that long to start thinking, this guy might pull this thing off. I mean, it's a big, and the number of times we see it. The last thing we want to do is sell legal documents to people who can't get their raise.
Right.
That's what it's conversations and all that. Like, I was just amazed your ability to execute. And again, it wasn't that long that I started saying, I think this guy's going to pull this off. But at every turn, it's like it was pretty amazing. The structure, the deals, and how you put that all together, because that's a very, very challenging raise to pull off, and launch to pull off. And so kudos to you to do that.
Couldn't have done it without you, my friend. And Brett was on speed dial for about a year and a half there. It's a long time.
Luckily, running it's been really easy.
No, it's like,
always the easiest part. Yeah.
Jake knows that side of things. He's seen me in the park. We're getting there. We're trying. All right. Brett, how do people find you?
Cenkus Law. So my last name, law.com, CNKUS law.com. We don't do a lot of free intakes, just too busy. So we have a paid line at clarity.fm/Brett Cenkus that you can book a call. You should get me the same day.
Love it.
You pay for that call, but roll up our sleeves and dig in and do work. If someone just wants to know, do we do this kind of thing? What are our rates and stuff like that? They could, hit us up through the website. But otherwise, calling that line, we could just jump right in, start getting advice.
That's perfect. Yeah. And the fact that you need to do it that way is just showing a level of expertise and demand you've got for your time. So it's highly would be worth it to speak with Brett if you need that service. I highly recommend. Awesome. This is Boulder Business. What we do, we talk about business, talk about whatever it takes. And you guys are awesome guests. Thank you all.
Yeah, thank you for having us.
Thanks for having us.
All right. Cheers. Thank you all for watching, and we'll see you next time.